In this presentation, we're just going to focus on the basics of Bitcoin mining, some frequently asked questions that we've received, and we're also going to touch on some trends that we're looking at moving forward. So starting from square one, what is Bitcoin? Bitcoin is, in simple terms, a digital commodity with a finite supply whose ownership is recorded on a distributed ledger. So we'll just touch on each of these three pieces in turn. First, Bitcoin as a commodity. Bitcoin is said to trade like a commodity. It's also regulated like a commodity in the United States. And Bitcoin mining as an industry and as a business has several similarities with other legacy commodity production businesses. We'll discuss this more in our conversation on Bitcoin mining economics, but just flagging that now. Second, a key value proposition of Bitcoin is its scarcity. Bitcoin has a programmatic issuance schedule that guarantees that there will never be more than 21 million Bitcoin. And one of the key innovations behind Bitcoin is, lastly, the blockchain. The blockchain allows for a distributed network of independent actors to agree on a central source of truth, namely which addresses own which Bitcoin. And the word Bitcoin is used a lot, so I think it's worth pointing out that Bitcoin refers to both the protocol and the network, as well as the asset or unit of account. And the key distinguish is the capitalization. So uppercase B equals the protocol network, lowercase b equals asset and unit of account. So enter Bitcoin mining. The Bitcoin network is maintained and secured by miners, which are a distributed group of economically motivated actors. And it's the process of mining that keeps the network in consensus. And if you look closely on the left there, that is a live image of Steve Barber mining Bitcoin by hand. So this raises some important questions. Firstly, so what do Bitcoin miners actually do? Well, miners add new blocks of transactions to the ledger or mine them roughly every 10 minutes. The second, in order to mine these blocks, miners must compete to solve cryptographic puzzles. Importantly, once a miner publishes a valid block, other miners begin working to create the next one. And this is the process of proof of work, but we'll touch on that a little bit more in the next slide. But importantly, only one miner can mine each block. Whoever mines each block is entitled to compensation in two forms. First, new Bitcoins, and second, transaction fees. These new Bitcoins are also called the block subsidy. And importantly for Bitcoin and for the programmatic issuance schedule, the number of new Bitcoins issued per block is predetermined and is cut in half every 4 years. So why is mining important? Well, miners facilitate the issuance of new Bitcoins. Miners also add transactions to the ledger, thus giving transactions a permanent order. And the permissionless nature of mining leads to a global distribution of miners, making the network secure, trust minimized, and robust to outages. But last and certainly not least, miners also provide settlement assurances for past transactions, as rewriting previous transactions would require repeating all the previous work performed to find the subsequent valid blocks. This would be very expensive and is part of the beauty of the proof of work consensus model. So let's just double click on proof of work and exactly why it's so important and what is proof of work. So as we've mentioned these cryptographic puzzles on the previous slide, to solve these, miners must perform expensive computation or work that cannot be falsified. We'll touch more on this in the next slide, but it's effectively guessing and checking solutions to a certain problem. And it's expensive because this computation necessarily requires the consumption of energy, and today, the purchase of specialized hardware. This is all to say that proof of work consensus means that nodes agree to accept the chain of blocks with the most accumulated work. And though proof of work does use energy, it provides several key benefits. First, it's permissionless. Anyone, anywhere in the world can mine Bitcoin. And this leads to the second point, which is decentralization. The permissionless nature of mining has resulted in a globally distributed network with miners participating from almost every continent. This also, as we mentioned in the previous slide, provides settlement assurances, as in a proof of work system, previous work accumulates in the ledger. And for this reason, it's far more difficult to manufacture a proof of work blockchain with the same difficulty as Bitcoin's blockchain than it would be for a proof of stake chain or some other consensus uh, mechanism. And given the requirement of physical infrastructure with proof of work, this leads to actually resilience of the network to price volatility. The fixed costs associated with proof of work mining equipment, physical infrastructure, power contracts, etc. These fixed costs incentivize miners to maintain operations and continue securing the network and mining transactions, even in the event of short-term price drawdowns. Even if Bitcoin has, flash crash down 30% within the matter of minutes, most miners have expenses due on a monthly basis. And so they're incentivized to at least maintain operations to see how the volatility shakes out versus other consensus models where the rapid decrease in price may lead to miners leaving the network. And lastly, the above features have led to a really strong track record. Bitcoin's network has boasted an uptime of over 99.98% over the course of its life. And so this is all to say, though proof of work requires the use of energy, it is this use of energy that makes Bitcoin so secure. So now we're just going to walk through exactly what mining looks like as a process. And this is maybe a little bit more technical than some of you might be interested in, or maybe not as technical as some of you might like. But I think it's just a good high-level overview of exactly how the network works. So starting at step 1, new transactions are broadcast to the network by senders. Step 2, miners choose these transactions based on fees, as miners are economically motivated actors who are just trying to maximize their profits. They use these transactions to construct potential blocks that could be added to the blockchain. And then step 3, many different miners work in competition to solve a cryptographic puzzle, spending electricity on time to find the solution. This, as I mentioned before, this cryptographic puzzle can only be solved via brute force guess and check. And the process of attempting to solve the puzzle is called hashing, because this cryptographic puzzle, to keep reiterating the same word here, actually just consists of miners throwing a large number of inputs into a cryptographic hash function. And though the output of this cryptographic hash function cannot be predicted, it needs to be below a certain target for the block to be considered valid. I've heard it described almost as miners are just throwing certain inputs into a magic box, hoping to get a certain output. And given the fact that they cannot predict the output, given a certain set of inputs, the only way you can solve it again is via brute force guess and checking. And this is the work that we talk about on the previous slides. Eventually, we hit step 4, and a miner finds a solution which results in a valid block. This valid block is then broadcast across the network and verified by other miners and nodes. And as each miner and node accept and determine the block to be valid, they add it to the blockchain, and everyone agrees that there's a new batch of transactions that's considered valid. Step 5, by adding this block to the blockchain, the winning miner is compensated for their work through both 1, the block subsidy, which are those new Bitcoins, and 2, transaction fees. And then, of course, with step 6, after this block is found and miners adopt it, everyone begins working on the next block and trying to add the next batch of transactions to the network. So now that we've talked about the what mining looks like from the network's perspective, it raises an important question: how do I actually mine Bitcoin if I wanted to? And importantly, to earn these Bitcoin rewards, you really need 2 key inputs: specialized computers, or ASICs, and electricity. First, on the ASICs, Today's mining equipment, we call them ASICs because today's mining equipment is powered by computers using application-specific integrated circuits, or ASICs. These ASICs attempt to solve the cryptographic puzzles that we mentioned, required to publish new blocks. They're just computers that are designed specifically to hash as efficiently as possible. And they work anywhere in the world with electricity, internet connection, and they're typically run in either data center buildings or shipping containers. Um, and I think from an economic standpoint, these ASICs are the CapEx side of the equation. Now, electricity is on the OpEx side of the equation, as the key cost of running mining equipment is this electricity. So again, with respect to the proof of work consensus and sort of the protection that it provides Bitcoin, this energy is the cost of attempting to attack the network by rewriting the transaction history. As we said before, if you wanted to rewrite a previous transaction, you would need to repeat all the previous work used to mine the subsequent blocks, which could be quite expensive in terms of your electricity bill. Um, and so, I think also this electricity component gets a lot at how a lot of folks, especially in the energy sector, think about Bitcoin mining, as energy producers often think of Bitcoin mining just as power arbitrage. They can take their cheap electricity and monetize it by mining Bitcoin. And so if we think about the growth of the network, this chart here just shows how the network has grown over the last 2.5 years. But even looking back beyond that, the network originally began as just a small number of computers, but today it's a massive array of ASICs and electrical infrastructure providing computational power to the network. The processing power of the network, as we mentioned before, is expressed in hash rate, or the amount of hashes per second, where each hash represents one attempt to solve that cryptographic puzzle we've been talking about. Given the scale of the network at present, the total hash rate is measured more often in exahashes per second. And for those who are a little less familiar with their scientific prefixes, one exahash is equal to 1 quintillion hashes. But from an individual miner's perspective, they can expect to earn block rewards in proportion to their share of the total network hash rate. So if you were to say control 5% of the network hash rate, you can expect to earn 5% of the Bitcoin mining revenue over a long enough time horizon. So thinking about 145 quintillion exahashes per second can be a little hard to contextualize. So putting it in dollar terms, the network as a whole today has a replacement cost of roughly $15 billion at current equipment prices. And in terms of revenue, the network generates roughly $20 billion per year at today's levels. This raises another question. Where are the Bitcoin miners? We've alluded to it before, but Bitcoin mining can be thought of as a permissionless energy sink. Consequently, Bitcoin miners are distributed around the world as they seek the cheapest electricity possible. This is because Bitcoin mining can serve as an energy buyer of last resort. And looking to the future, we expect this trend to continue. I think Nick Carter, who's actually going to be speaking next week, came up with a really nice thought experiment to illustrate how Bitcoin miners seek locations and where Bitcoin mining will go. In the last word on Bitcoin's energy consumption, which unfortunately was not the last word, but he said, imagine a topographic map of the world, but with local electricity cost as a variable determining the peaks and troughs. Adding Bitcoin to the mix is like pouring a glass of water over the 3D map. It settles in the troughs, smoothing them out. And so as we think about that analogy, you look around, you look at this map in front of us, you see Bitcoin mining tends to flock to the most energy and power rich regions of the world. Historically, there's been a lot in China, both due to the cheap power, but also due to the proximity to ASIC manufacturers. But we're starting to see more and more miners come online, especially in North America and other power-rich regions of the world. And this is in part due to new regulations coming out of China, but also Western capital markets taking notice of Bitcoin mining as an investment opportunity, and really trying to use Bitcoin mining as a tool for the local energy markets. And so, in context, though many have talked about Bitcoin's energy consumption, whether good or bad, the Bitcoin mining network as a whole uses about 14 gigawatts as of the latest estimate from the Cambridge Center of Alternative Finance. And for context, this is only about 0.07% of global energy production. And now that we've discussed the location of miners, I think it's worth pointing out just the general breakdown of the industry itself. Mining is distributed, but it's also multifaceted. And though in simple terms, mining just consists of computers using electricity, the growth of Bitcoin in mining has resulted in a diverse ecosystem of different industry participants using a variety of different business models, everything from ASIC manufacturers to mining project investors. We won't go through this slide in too much detail just because there's nuance with all these names and there's a lot of detail here, but we think about them in terms of four key buckets. So in top left, you have the ASIC supply chain, really anyone who's in the business of producing or selling the mining equipment we talked about. In the bottom left, you have the pools, which help serve to facilitate miners collaborating so that they can smooth out the variance in their earning of block rewards. You have mining facilities, which includes everything from co-location service providers to proprietary miners. And then lastly, you have financial products and financial service providers. In addition to providing sort of derivatives and lending products to miners, they also provide investment capital, which is a big fuel for growth in the industry. So now that we have discussed just some high level basics about Bitcoin mining itself, we're going to move into some of the frequently asked questions. As I mentioned before, my team and I have been giving this teach-in to institutional investors for over a year. So I've just selected some of the most common questions we get from institutional investors. Typically, a lot of these come up during the first 5 minutes of the presentation and tend to occupy the rest of the time. So the first question is, how do we know Bitcoin supply is actually capped? Given the rampant monetary expansion we've seen over the last year or two, much of the macro narrative around Bitcoin has centered around its scarcity, particularly as an inflation hedge. And so as a result, institutional investors have been very curious about how this is ensured. Earlier, we mentioned that new blocks are found on average every 10 minutes. And to reward miners for finding these blocks, the network gives them new Bitcoins in the form of the block subsidy. However, the number of new Bitcoins issued per block is cut in half every 210,000 blocks, or roughly 4 years. These block subsidy reductions are called halvings. For example, when Satoshi launched Bitcoin on the far left of that chart, the block subsidy was equal to 50 Bitcoins per block. Then in 2012, after the first halving, it was cut to 25 Bitcoins per block. The second halving took place in 2016, further reducing the block subsidy to 12.5 Bitcoins per block. And then the most recent halving occurred in May of last year. And this halving reduced the block subsidy to its current level of 6.25 Bitcoins. And looking out into the future, given the fact that the smallest denomination of Bitcoin is actually 1/100 millionth of a Bitcoin, this is also called 1 Satoshi. This means that the very last block subsidy will be equal to only 1 Satoshi. And because of the programmatic supply schedule, we can actually forecast within a margin of error when the last Satoshi will be mined. And currently, we expect that to be in the year 2139. And so as a result, as these block subsidies decrease over time, this is what results in the asymptotic approach of 21 million Bitcoins for total supply. This previous slide tends to raise another important question, which is what happens when the last Bitcoin is mined? Even before it is, what happens when the block subsidy becomes increasingly small? Why would a miner continue to mine Bitcoin when they will only receive 1 new Satoshi per block? And the short answer is transaction fees. As we mentioned before, there are 2 streams of revenue for miners. First is the block subsidies, as we mentioned, but then second is the transaction fees. As the block subsidy decreases, a robust fee market we expect will start to develop with more miner compensation coming from variable transaction fees. We can already see this taking place over the last 2 halvings, as transaction fees have steadily increased to become a larger portion of miner compensation. And so if you look in this chart here on the bottom right, you can see that the Q4 2017 fee crisis did show that this robust fee market was starting to develop. But then even post this most recent halving, we've seen sort of a steady increase in the transaction fees, which is good for the network. Next question that we often receive is with respect to the block times. How can we ensure that new blocks are found only every 10 minutes? And the short answer there is the difficulty adjustment. Earlier, we mentioned that miners are trying to solve a cryptographic puzzle. Well, the difficulty of this cryptographic puzzle adjusts every 2 weeks, so that on average, it takes about 10 minutes to solve. Satoshi implemented this feature to ensure that blocks will take 10 minutes to mine, whether the network consists of 5 computers or 5 million data centers. And this property, coupled with Bitcoin's halving events, which we just mentioned, is what allows us to plot the future issuance of Bitcoins with such precision. We can expect that a new block will be found every 10 minutes on average, because this difficulty adjustment will ensure that even if the computational power of the network doubles, so too will the difficulty of solving this cryptographic puzzle, resulting in sort of stable block times of around 10 minutes. And in my opinion, I think this is one of the most beautiful aspects of Bitcoin. It's this dynamic adjustment that just makes the network so flexible. And I think it is just beautiful and a testament to the genius of Satoshi. All right, now that we have touched on some of the key trends in Bitcoin mining today, now that we've touched on some of the most frequently asked questions, we're going to touch on some of the key trends to give a sense of how the industry may change over the next few years and what to keep an eye out for. When I think about the future of Bitcoin mining, I see really 4 key trends, and we're going to discuss each of them briefly here before exploring them in a bit more detail. The first is what I call the great migration of hash rate. The second, mining is saturating the energy sector. Third, the hardware is becoming commoditized. And fourth, this is all leading to the institutionalization of mining. So quickly to touch on the first point, as we mentioned before, the recent regulatory action in China has led to miners leaving the country as they seek either geographic diversification or find permanent new homes. This is because mining is a capex heavy business, and so miners want regulatory certainty or regulatory assurances when they plug in machines and spend millions of dollars on them. At the same time, we're also seeing other energy-rich countries, particularly those with robust capital markets like the United States and Canada, who are seeking to expand their domestic Bitcoin mining operations. There have been many press releases this year about massive purchase orders coming from public North American miners, and this is serving as sort of a carrot attracting more and more hash rate to North America. To the second point, mining is saturating the energy sector. As Bitcoin adoption increases and Bitcoin mining grows, we're simultaneously seeing both Bitcoin miners vertically integrating with energy resources as they seek the lowest cost power, but we're also seeing energy producers utilizing Bitcoin mining to monetize surplus energy. As we said, Bitcoin mining is a permissionless energy sink, and you can just take advantage of cheap power anywhere in the world by plugging in some mining machines. And meanwhile, Bitcoin miners are increasingly providing demand response services for energy markets. This, paired with the improved hedging products like some of the hash rate marketplaces coming online later this year, will likely only accelerate this trend, as you can mine Bitcoin without necessarily being as exposed to the Bitcoin risk. To the third point about hardware being commoditized, over the last 8 years, Bitcoin mining ASIC manufacturers have caught up with the rest of the semiconductor industry and are now also testing the end of Moore's Law. This has led to equipment now expecting to have a useful life of 3 to 5 years as opposed to 18 months. And marginal improvements on new generations of hardware are expected to be incremental instead of step changes. And lastly, the first 3 contribute to this, but mining is becoming increasingly institutionalized. It's evolving from a cottage industry to an emerging investable asset class. And as a result, I also think that the risk of Bitcoin mining is, in my opinion, a little bit mispriced. And with the macro environment of near zero rates, Bitcoin mining can be a really attractive source of returns to investors who can properly underwrite projects and get comfortable with the Bitcoin risk. And so as this institutional capital is entering the space, we're starting to see large scale mining projects being conceived and developed in low cost regions in the US, as well as new forms of financing as investment capital seeks returns that provide outsized reward. So let's just double click on some of those points we mentioned and dive a little deeper into sort of why there's such interesting trends to watch and kind of what's driving them. So first, let's just take a look at point two, which was the intersection of Bitcoin mining and the energy sector. Um, Cheap power lies at the heart of Bitcoin mining economics, but there are several other unique properties that allow energy producers to utilize mining in order to monetize wasted energy or idle capacity in an efficient way. The first is that Bitcoin mining is location agnostic. You can mine Bitcoin anywhere in the world. All it takes is power, an internet connection, and the specialized hardware that we talked about. Second, Bitcoin mining can serve as a flexible load, as Bitcoin mining equipment's power draw can be scaled up and down without damaging the equipment. The only cost is foregone mining revenue. In fact, this can be done quite quickly on the order of magnitude of minutes, as opposed to traditional data centers that maybe need certain uptime requirements for their customers. Third, Bitcoin mining has no customers, unlike those traditional data center businesses. So this means Bitcoin mining operations require little manpower and overhead, and again, are even more flexible as they are beholden to no customers or no contracts. And then lastly, Bitcoin mining is really power dense. So the buildings and shipping containers used to house Bitcoin mining equipment actually have power density of up to 100 times greater than traditional data centers, which means you can have a lot of power being channeled into a very small geographic footprint, which allows energy producers to tactically place Bitcoin mining um, operations in a variety of physical footprints. And so these four factors have led to a couple different interesting examples of Bitcoin mining in the energy sector in the wild. Um, the first is this idea of grid balancing, or this term that many have used, much to my chagrin, of Bitcoin batteries. So the idea here is that many Bitcoin miners, especially in places like ERCOT, achieve ultra low cost power by curtailing when demand is highest and selling power back to the grid during these periods of peak demand. Um, these projects are called Bitcoin batteries because the fact that they usually provide a stable demand means that when they switch off their machines, you're now releasing power that would otherwise be going towards the Bitcoin mining operations elsewhere in the grid. So though you can't really plug your phone into to Bitcoins or to Bitcoin miners, um, their foregone capacity is it's almost similar to new generation coming online elsewhere in the grid from a grid operator's perspective. And this can be tremendously valuable as it provides an incentive to build out energy generation capacity um, during sort of during just stable periods and during normal times. And then when they shut off, that can provide a massive relief to the grid elsewhere. And this is especially important as we've seen with certain grids like ERCOT and in Texas that have had some issues with having the power that they need during times of peak demand. Second category, moving on from grid to off grid, is this trend of flare mitigation. So for oil and gas producers, natural gas is often a natural byproduct at the oil wells. And so in order to reduce this otherwise flared or wasted gas, some oil wells deploy containerized data centers at the well to monetize otherwise wasted natural gas through Bitcoin mining. And we've seen a variety of companies in the space emerge around this business model, whether it's Great American Mining, Crusoe, or Upstream Data. And this seems to be a real trend moving forward, as it's actually really quite helpful from an environmental perspective to reduce the venting and flared gas, as the methane or the natural gas that is often found at these wells has the greenhouse gas equivalent is about 25x worse than CO2. And so this is just a kind of a big boon to the oil and gas producers who have traditionally struggled with dealing with this gas. And then lastly, with another use case is just revenue augmentation. So some commercial power plants have begun integrating Bitcoin mining operations directly on site to create a supplementary revenue stream and to ensure that the power plant is running at peak efficiency during the day. And this is because certain power plants have different sort of scaling profiles, and so it can be really inefficient to try to scale generation up and down, say from 0 to 10% of capacity. And so Bitcoin mining can serve as a sort of a stable source to maximize the efficiency of the power plant and also to provide some uh, supplementary revenues. Moving on to the next trend, as we mentioned, Bitcoin mining is now becoming investable for the long term because of because of the commoditization of hardware. So this chart here shows the evolution of the hardware used to mine Bitcoin since the launch of the network. And from 2009 to 2018, the Bitcoin mining hardware ecosystem was really just catching up with the rest of the semiconductor industry. Miners saw new generations of equipment experience step changes in efficiency over the previous models, which made it really difficult to invest in. You were buying a piece of hardware that could potentially only have a useful life of 12 months before it became uneconomical due to its inefficiency. And now that Bitcoin mining has established itself as a viable industry, there's really a strong ecosystem of hardware manufacturers that all leverage the largest global foundries in the world, like TSMC and Samsung, and a global supply chain has emerged to provide reliable equipment to miners. This is also paired with the fact that now that the latest Bitcoin mining hardware utilizes 5 nanometers and 7 nanometer chips, which is the same as other latest generation semiconductors. And the fact that the broader semiconductor industry is now also approaching the end of Moore's law, as quantum tunneling establishes lower bounds on chip sizes. And so this leads us to believe that we're entering a new paradigm of largely commoditized hardware with longer life cycles of 3 to 5 years instead of 12 to 18 months. Since we really entered the ASIC era in 2013, this is sort of kind of been a whole new world for Bitcoin miners. And for example, one of the oldest pieces of hardware that's still being run by Bitcoin miners is the Bitmain S9, which has also been called by some to be the AK-47 of Bitcoin mining. And this hardware was released back in 2016 for the first time, and you're still seeing miners around the world run it profitably if they have sufficiently low electricity prices. So we think this trend will continue. And then lastly, we're starting to see Bitcoin mining become increasingly institutionalized. And this is not to say that there are no successful retail miners that you can't mine, as a retail miner profitably. But we're just increasingly seeing a lot of institutions get interested in the space and start to invest. So, really, Bitcoin mining used to just be solely a cottage industry for hobbyists and enthusiasts and kids mining Bitcoin in their dorm room with free electricity. But we've really seen a proliferation of large scale projects and large scale investment as corporates and institutional capital become more interested. So, if we look back at and you see some of the names on this chart, whether it's SBI Holdings or Blockstream and Fidelity, the interest really started picking up a couple years ago, and then it's only seemed to continue with the most recent, I'd say, big announcement coming from Square when they announced to commit $10 million to the Bitcoin Clean Energy Initiative. And so as we look forward, we think that this trend will likely continue, again, driven by the desire for yield and returns in a near zero interest rate environment. But also people waking up to the fact that the risk might be mispriced in Bitcoin mining and there might be a real opportunity here. So with that concludes the presentation. We finished up a little bit early here, so happy to give everyone else 20 minutes back to their day. But if you do have any questions, please join us tomorrow when we have our Twitter Spaces Q&A. We'll be happy to answer any questions there, and feel free to reach out if there's anything else. But thank you very much, everyone.